What do you do when you repossess a home and the numbers tell you that selling it is going to mean you take a loss?
You're hoping the borrower doesn't default because now your LTV went from 80 to 85, 90, 95, maybe even 100, maybe even more than that.
Between fees, the legals, the interest that's owed, and I haven't sold it yet. I'm going to have to be at like another 3 months at least, maybe 4, maybe 5, because the market's slow. So every month, $5,000, $5,000, $5,000, and more legals. So you start to feel like you're underwater. Well, now you look at it and you determine, okay. All right, welcome back to The Wealthy Lender. This is episode 14. I'm Chris Nichilo, licensed mortgage broker, financial literacy advocate, and founder of Magnetic Capital Group, Canada's premier private mortgage firm. And today, we're tackling one of the toughest realities in private lending, Nick. What do you do when you repossess a home and the numbers tell you that selling it is going to mean you take a loss? And most lenders don't talk about it, but if you're in this business long enough, you are going to find yourself in exactly this position. So in this episode, I'm going to walk you through how to think, act, and make the hard decisions that protect your capital when the math doesn't go your way. What do you do, Nick?
Okay, this topic is fascinating.
It is.
I'm really curious about your thought process with this because say you've lent in May of 2022.
Yeah.
Rate increase announcement, 1%, just boom, overnight, keeps increasing. You've lent on a property and, over the next few months, next couple of quarters, you see the values sort of declining in the area you've lent. You're hoping the borrower doesn't default because now your LTV went from 80 to 85 to 90, 95, maybe even 100, maybe even more than that. I can't speak from experience on this. I'm really curious, like which gears start turning? What's the thought process? Do you just go into panic mode? Like, what are you thinking?
Well, there's a lot to consider. Okay. So there's a lot of things to think about. And I think that the number one rule is you have to truly treat each case on its own merit, case by case. You really do, because it's a combination of factors that will dictate what makes the most sense. Now, let's talk about the priorities. So before we even look at this situation or a situation, I'll just make one up or talk about an old one. But what are your priorities? So remember what's happened here, okay? So, and let me give you some context. So let's imagine that you have 100 loans under administration, and 97 of them are just paying as agreed. And you got these 3, okay? And these 3 are in various stages of, let's call it, flux.
You're saying events of default, or?
Yeah, so we have 3 stages of default to help define what a default is, because technically it's a default if someone misses their payment that's due on the first of the month, and it's in default until they pay it. But that's not a serious default. We call that we label that default 1. When someone defaults, we give them 5 business days to fix it. From the time we first notice it, we send them a letter. It's very gentle, very, very, reminder-ish, if you will, and we give them 5 business days. So at the end of that 5 business days, if they haven't resolved it or gotten in touch and we're not working on resolving it, then we send them a default 2 notice, which puts the mortgage in actual default status. The first stage, even though we call it default 1, you might just get a missed payment notice, not a default notice. The default notice gives you another 15 calendar days to fix it. However you want to fix it. Call us, talk to us, we'll work something out, whatever, right? Tell us what's going on. We'll see if we can figure it out. If you haven't done anything by that time, now 22 days have gone past. And remember, the next payment is due, say, in 8 days. So that's when the legal process starts. And it also begins very gently with a demand notice, right? So it's a little more serious because it's coming from a law firm, but it's really just a demand notice, and it has a grace period. And then from there, you get into issuing a notice of sale or a statement of claim, each of which also has a grace period. So by the time you get to a position where the title of the house may be changing hands, right? Like you're really enforcing the collateral. And by the way, default 1, then default 2, 5 business days later, 15 calendar days later is enforcement, which is when the lawyers get involved. So by the time we get into a position where we are in possession of the house, it's been a few months. And
Like
so
2 or 3?
yeah, around 3. It's over 50 days.
Okay. And during that process, are you monitoring the LTV and sort of strategizing in parallel
So
stuff related to
here's
the collateral?
great question. So yes, you're managing all of this, but I want to again bring context to it that from a priority perspective, your number one priority when 3 of your 100 mortgages go the wrong way, right? So they're headed in the wrong direction, and you're going to need to enforce your security, which is fine. You're prepared for that from day one. So this is not like, don't panic, just go through the process. From the time any one of those gets into default 2, you're starting to put your attention on it. You're having a look at it. You're analyzing it, looking at, okay, what's the run rate, for example? So if the borrower stops paying and continues to stop paying, how much is being added to the total owing on the account every month in unpaid interest, then unpaid fees, administrative and legal. So you're starting to be able to project, okay, if it takes me 3 months to get possession and then another, let's say another month to evict the borrower, and then it's 4 months and I'm listing the property for sale, and then it takes 3 months to sell and another month to close, that's 8 months. So you can do this math. You can look, out into the future and say, okay, this is where the bill is going to be by that time. And so how much do I need the property to sell for at that time in order to make sure I get all my money back plus interest and the fees are paid and everything's the real estate commission, legal fees, all that's all paid.
And you're doing this case by case, or you're always assuming the worst case scenario where, I might have to evict this person, because you might not.
Every case is different. You're right. So there's a lot of wiggle room in this process because ultimately you would prefer to have the borrower voluntarily sell the property. If you can't, that'll save money. But the risk is, are you in complete control? Is the borrower fully cooperative so that you're in control? Because when you get possession legally, you're in charge. You pick the realtor, right? Before that, it's collaborative and you have to make a decision whether or not you want to trust the borrower to work with you. Because if they stop working with you at any point, you just have to carry on with enforcement.
Right. Okay.
If they're working with you, then a lot of doors open because you can, there's so much you can do. Hey, your mortgage payment that you missed was $4,000 or $3,000. Yeah, I missed that payment on the first. Okay, well, how much were you short? Well, I only had like 2,200. We'll send that in. I mean, just because you don't have the other 800 doesn't mean you don't send the other 22. Send the 22. And then what? Well, if you send the 22 and you keep sending 22, my bill isn't going up as high. It buys me more time and it allows me to work with you to choose the right real estate team, get the market house on the market in the best way possible to drive the highest value in the shortest period of time, and bring this whole thing to a conclusion without putting on the listing that it's under power sale.
When you say my bill isn't going up as high, you mean the fees that you're going to be putting
No,
against
the interest that's accruing. Remember, you start, let's say, with a $500,000 loan at, let's call it 8%.
Yeah.
Okay, that's $40,000 a year. That's $3,500 a month. So if you're up to date in interest, you owe me 500. You sell the house for 550, you should be good. If you stop paying, now next month you owe me 5035, then 507, then 510,
I
then
see.
515,
I see.
and so on and so forth. Now add in legal fees and then reverse calculate for commissions that are being paid to a real estate agent and so on, right? So you have to be forecasting all of this. We have to look at it and say, okay, what do we have to do to get out of this as quickly as possible without incurring any more cost than necessary? The easy way is to work with the borrower, but some of the challenges you run into are things like the borrower wants their cousin to sell it.
Mm-hmm.
I don't want their cousin to sell it. I want the very best local real estate agent in that market who knows that market, who's connected in that market, knows where the buyers are in that market, and is going to set that property up to show well and all the rest of it. This is no joke. The liquidation process is no joke. In fact, working with the borrower is the best for both worlds because it preserves the integrity of the property. So there's no power of sale. That is a black mark on a listing, right? You'd rather not have it. Sometimes it's a reality. It is what it is.
You're saying it invites lowball offers?
Of course.
Yeah.
Better to sell under no duress.
Mm-hmm.
So that's the first conversation I'm going to have with the borrower. Hey, how bad is it? Can you get back on track? If it's not realistic that you can get back on track, I'm going to be very, very honest with you. Look, I can't stop the snowball that's rolling down the hill without your cooperation. We represent investors. We have to act in their best interest at all times. We have to move through the process if you're not meeting your obligations. However, none of these investors want your house. We want you to stay in the house, pay us back, and thrive, prosper. So we're open to exploring every possible way in a short period of time, because we're not going to give you forever. We're not going to take forever when you're already in a crisis. But we're going to see if there's a way we can refinance, restructure, redo anything that we can do to let you stay in the house. But it has to be viable, not your heart. It's not your heart that says you want to stay in the house. It's does the picture make sense, or are we delaying the inevitable, kicking the ball down the street for no good reason?
Is the mathing?
That's the math. Yeah. And you can show them the math. Okay. And then now you get into, okay, now we're on the same page. Now we can have some influence, help choose the realtor, interview them, find the right person to sell the property, list it properly, right? The idea is not to find a realtor who will do it for 1%. You will lose when you win playing that game. Like, I am way more confident that a realtor worth 5% is going to sell my house for enough to get themselves paid and get me my money back too.
Yeah.
So,
okay. So we've accepted that it's time to sell. And now we're looking at the LTV and we have a bad surprise.
Yeah. We look at the numbers and it doesn't work. It doesn't work. Now you have some difficult decisions to make. So now the decision is, okay, let's say, I think you said at the beginning, you got into this in, say, 2022.
Yeah. Say, Q2.
Okay.
Yeah.
Let's say you were in it starting in 2023. Okay. You're in it for a year. You got paid, no problem. You're in it for another half year. It renewed for a second year. Halfway through that second year, you've made 18 payments have been made to you, right? So you've made a year and a half of it. Let's say it was at 10%. So now you've made 15%. Payment stop. We're a month past the payment stopping. We're into enforcement. And now it's becoming a potential reality that we may have to take possession of this property and sell it. By the way, very rare does it get to there. even if 3 properties, like I said, out of 100 are in like a state of flux, a missed payment, default 1, default 2, so rare we get in possession. Maybe 1 a year. Could it happen 2 or 3? Sure. We have many months where there's no missed payments at all. It's just rare. Not impossible, rare. So now you go to you do the math and it doesn't look good, like you said. Values have dropped, and conspiring that with interest payments aren't being made, and so that the bill is climbing, and now you got legals and all the rest of it, and you just look at it and you go, I don't think this is going to work. The next question should be, well, how bad is it? So if I said to you, let's do a real fake example. So the mortgage is for 800,000 against a value of $1 million in 2023. They've paid interest for the first 18 months, and now you're 2 months, 3 months past that. So on 800,000, and let's say this is a first mortgage, and let's say it's a reasonable interest rate, 8%. So you're $64,000 a year in interest. 5,500 roughly. My phone was connected to my headset, and my phone just sent a message. I think it heard something like Siri heard me. And anyways, talk to me. Sorry, where was I?
So it's $1 million property.
Oh yeah, $1 million, 800,000.
Lent 800.
8%, 64,000.
Yeah.
It's like 5,500 a month.
Yeah.
So now 3 months past when the person stopped making payments, you're now another $15,000, $16,000 added to the 800. So now the bill is 816. Plus by that time, now you got say $5,000 in legal fees. You're at 821. Now you're going to have to pay say 5% to a realtor to sell it. And the market has come down to where this property is only worth 850.
Right.
Now you're looking at it and you're like, well, between the fees, between the legals, between the interest that's owed, and I haven't sold it yet. I'm going to have to be like another 3 months at least, maybe 4, maybe 5, because the market's slow. So every month, $5,000, $5,000, $5,000, and more legals. So you start to feel like you're underwater. Well, now you look at it and you determine, okay, if I got all my money back right now and I didn't get, or let's say if somebody said to me, you can have your money. So you're 3 months into no payments, right?
Yeah.
Guy hasn't paid for 3 months. And you know it's going to take 3 or 4 more months to sell it. So you're, say, 7 months of unpaid interest. If I said to you, when it's all said and done, you will have been in this for 20, 24, 25 months. Call it 24 for even numbers. Okay. You're in it for 24 months, but you only made interest for 18. So you made 15%, right? Because you're 8% in year 1. You made 4% in year 2. So you've made 12%, but you've been in it for 2 years. And when you got into it, you expected to make 8% interest. But if I offered you your money back at the end of the 6 months, so now 3 more months, you got to wait, and then you get your money back. But it means that the entire investment was a 6% return for 2 years rather than 8% for 2 years. What would you do?
Give me the money.
Take the money. And
Live to fight another day.
And don't take the money and walk away when private lending sucks. First of all, this was 1 in 100. 2, 3 in 100. Okay. So you're batting 97% for getting 100% of exactly what you expected every single time. Now, from time to time, there's a landmine, something happens, you run into one of these.
That's why you get the premiums.
Of the 3 or 4, of the 3 or 4 that do, only one of them goes the distance, where you have to take over the property and sell it and all this. And if I said to you in that one, you're going to get 6 instead of 8 at the end of the day, even if I said you're going to get 4 instead of 8, or worse than that, you're going to get your money back on that one and you didn't make any return for 2 years on that piece. You don't focus on that piece. Focus on the 99, 98, 97 that were flawless. That's a brilliant track record, any investor would tell you. So it's a matter of perspective and understanding that it's hard to lose in private lending. I mean, look what went wrong, and I told you you're able to get your money back. It's because if the house was worth $850 and all that was needed to pay back was the $800 plus the legal fees, you can make that work. Very close to making that work. But when you add that 6 or 7 extra months of interest because the meter was running while you're going through the process, it can hurt you. Even like I said, and you can apply that thinking to any scenario. So we call it net zero. Anything between full payout and net zero is good in a default enforcement worst case scenario.
Okay.
Net zero is you got all your money back and you did not end up making a return. You're not in a loss until that happens. So think about it this way. Every time you get paid, every month you get paid is insulation towards loss, because you're building up interest that has come. And because we know the default rates are so low and the enforcement rates are even lower and the loss rates are even lower, you can feel very good about it no matter which type of private mortgage you're in, as long as you're in my opinion, a range between around the 6 to 11% against residential properties. So the point being is, when you can't sell because the numbers don't make sense, you might still want to sell, because the numbers can still make sense globally. Now, what if they don't? What if it can be catastrophic? What if, the value drops so severely that
You want to do like a second position scenario, or?
Yeah, you're going to get wiped out. You still have the right to hold the property. Now, if you're in second position, the reason second position is riskier is because of LTVs. It's because you're behind the first and out of priority. And so if there is some catastrophic result, you are extremely vulnerable. And the only way that you can control the process in a default is if you keep the first mortgage paid. Now, I'll give you a good example of where this is a big problem. So just today, I get an application from a broker, and they're looking for $6.6 million, I think, $6.6 million against a property valued at 7.8. It's 75% or 80%. And I can't remember, maybe it was 9 million. Anyways, it was around 75% of the value. And I said, well, we don't do loans that big. We just don't. There's no need for us to take that much money and put it into one mortgage. We can spread it around into a whole bunch of mortgages. But nevertheless, the example is good. So when I sent that back to him, he said, well, what's your max? I said, 2 million. He said, well, what if we do a first with somebody else for 5 million and you do the second for 1.6? And immediately I said to him, here's what you need to understand about the lender's perspective on this type of opportunity. Sounds amazing. 1.6%, 75% of the value, and so on. My head goes immediately to the first mortgage. If ever there's a default, that first mortgage at $5 million, probably going to be like 30 grand a month in interest. And so for me to control my position, for me to secure my position in a default and make sure that I control the sales process in second position means I have to make sure that the first mortgage is getting paid every month. Borrower's not doing it, I have to do it. 30 grand of cash flow out of the business every month just to service this mortgage. I will never take that risk.
I see. Yeah, it's still on you.
And then if he's not paying my mortgage, it's another 15 grand. The meter is growing. every month. That's where you get into disaster. You shouldn't be doing a $5 million or $6 million mortgage if you don't have those kinds of pockets. You have to be, look, we could take over a first mortgage, where the payment is $3, $4, $5,000 a month. We can do that for a while to protect our position. 30 grand a month.
Yeah, that's
You could,
heavy bleeding.
one day, maybe the way we're growing, we might get to a place like that, but you have to be smart. Like, you need to be, you have to have many millions of dollars behind you, in order to take that risk. Because you can stem the tide. Look, if you can stem the tide for a year, if you can pay the 30 grand a month for a year, you can get through the process. And then as long as your underwriting is good, you can get out and you'll get all that money back. But if not, you're going to struggle. So you have to be very careful with things like that. Don't bite off more than you can chew. Don't take off more. But if you find yourself in a position where the math doesn't work, you can hold. That's the idea. You can hold. What do you do to hold? Well, you can do lots of things. You could improve the property if you want. If you think that's going to make a difference, it's mathematical. It's obviously a bit of a gamble, right? Like you want to improve it and then try to sell it for more. Do you want to improve it and cash flow it by adding a secondary unit that can generate more rental income and maybe service the mortgage that way? Lots of things you can analyze and go through. But the key, okay, I always tell people there's 3 things that have to happen in order for you to lose money in a private mortgage, at least the way we do it. Number 1, the value of the property has to drop significantly within 12 months. Right? Because we're not ever lending more than 80%, which means it has to drop more than 20% just for us to get into that like danger zone. And our average zone is 70%. So we've got a bigger buffer. So that has to happen. Number 2, the borrower has to stop paying. And the good news about number 1 and 2 is they're not positively correlated. It's not like if somebody finds out their house is worth less than it was yesterday, today, their response isn't, okay, I'm not paying the mortgage. Okay, but now the difficulty about those 2 things is that they are out of your control as the lender. Neither one do you control. You don't control the market. You don't control what the borrower pays. But the third thing that has to happen for you to lose money in a private mortgage, you have to sell the property at a loss once it's in your possession. And that you control. So
Even in second position, I really like the idea of like, yeah, if you're in second, well, then just control the first position.
yeah, you got to think about that before you do it.
Yeah.
Okay, but yes. So it's hard to lose in a private mortgage. And the key here is that you control that third piece and you have options: renovate, improve, hold, rent, time, right? Because what the real estate market historically has shown us is that what goes down comes back up.
Yep. And like if you are in second and they keep making their payments on the first, technically that equity buffer just keeps improving over time as well. So that's a benefit of holding.
Yes, and work with the borrower. Work with the borrower when things are bad. Don't be unwilling to modify terms, give somebody a bit of a break, prevent it from getting out of control. Look for a solution, obviously within reasonable terms. I'm not suggesting you give charity to borrowers who can't pay. Just saying, if there's a way out, a viable way out, if something happens that's like sudden, God forbid, okay? We've seen this happen. A borrower dies. And the family is scrambling to try. It was a healthy loan. The family's scrambling. It's worthwhile to take a breath, talk to the family once the dust settles a little bit and emotions are under control, and then try to see what are they planning to do with it? How can we keep the payments coming until that time? Can we work together? Can we do, it's not until communication breaks down that you really have to get too serious. And as we talked about in another episode, collateral is so powerful.
Yeah.
right? So they don't want to lose the house. Nobody wants to hand you the keys to their house. And we don't want to take the keys to the house. We don't want to be landlords. But when we need to be, it can be a very good way to stem the tide.
This is also something you mentioned in a previous episode, like that the difference in borrower behavior sometimes is like it simply comes down to the initial tone of the conversation.
Yeah, I mean, we dictate, right? Everybody knows who has the collateral and who has the upper hand. We don't have to take it and hit people over the head with it. You just have to be nice and welcoming and open and let people know that, your intent is just to complete the business transaction we contemplated at the beginning. It's not to not listen, the win-win of private lending is you get a borrower who did enough right to get into the housing market and build equity, usually up at least, 30 to 40% equity. In order to come to us, you need to have 30 or 40%. So you did something right, something happened, and now things are off the rails. Well, you are the opportunity to help that person stay in the house. You're the last stop as a private lender. So they no longer qualify for whatever reason at the bank, but accessing the equity in the house might be the answer to getting back to the bank inside of a year or two. And that's the mentality. Win-win. The win-win is you as a borrower come in under a set of circumstances that are fixable within 12 to 24 months. That appears to be a viable solution. And if you are, you're also able to make the payments of a premium interest, right? More than you would pay the bank for that 12 to 24 months. You're able to make the payments, which creates the win for the investor. Now, the next win, so you get access to the equity you need. That's number one win for you. And the investor gets into a situation where now they are earning a premium. Great win for both. Now, the next win is the true win, and it's for both. And it's when you exit.
Yeah.
You get out of private and back to a bank at a better interest rate, and you are back on track, and the investor gets their money back.
That's when both parties go, whew.
Winner, winner, chicken dinner.
Yeah.
So everything that is done between those 2 points of entry and exit should be in collaboration. You should be working together to get to that end. For as long as possible, the investor ought to, or the administrator in our case, is that we're representing the investors, ought to work to make that solution happen for both sides. They get in, they get out. There comes a point in some cases, unfortunately, where as a lender, you have to realize there is no longer a viable solution that would result in a refinance, and the only exit available left is a sale. From there, the question is, are you going to sell it together in cooperation? Is the borrower able to wrap their head around the fact that it's time now? And if that's the case, great. That's also a positive, because there are two ways out of a private mortgage: refinance to the bank or sell. If refinance becomes an unviable option, as long as both parties recognize that the only option left is to sell, well, then they're both aligned on the goal: sell for as much as possible, enough to get the lender back their money and for the borrower to walk away with money in their pocket too.
And you get them to agree on this common goal before you even lend the money.
That's correct.
Yeah.
And if it breaks down, it's usually because the borrower doesn't want to accept that it's time and wants more time, wants to hold out for a miracle.
Yeah.
And that's where a good lender has to be able to say, look, I can't do that. We have to go through the process. And if cooperation breaks down, we have to, as a last resort, enforce security using the legal process. but it adds more cost. It results in more risk to the investor and less left over at the end, less equity once the sale is gone for the borrower.
Yeah. Well, hey, those
Great topic.
when that happens, 3% of the time, those 3% niche case, situations where that does happen, that's probably the reason why you're making 7, 8, 9, 10%.
Yeah.
You're
Yeah.
being paid
And
for that 3% of the time where you got to be, you got to have your thinking cap on, and you just got to be creative with it and find solutions.
exactly. And you know what? We'll do some episodes maybe where we actually dissect a real world case of something we dealt with.
Oh yeah,
Where
we got 3 of those on the books.
yeah. So that's great. Okay.
Yeah. All right.
All right, all done.
Talk soon.
Have a good night.
Bye bye.